These days, it's crucial to be financially literate and business savvy. In the third part of this 4-part series, we talked about the important keys to successful investing. In the last part of the previous video, we listed the 8 crucial keys to successful investing, and we also predicted how our business would go if it earns a 10% to 20% return every year for 43 years. In this video, we'll learn the psychology of investing and mutual funds. Welcome to Knowledge Pilot. Pay off high-interest debt. Are you ready to invest now? If you're a student right now, you probably have student loans. Perhaps you even have some credit card debt. You shouldn't invest in the stock market when in debt. When you have some money you won't need for 5 to 10 years, then invest it in the stock market. If you have high-interest credit cards, pay them off before investing in the stock market. Student loans are probably cheaper than credit cards, but if they cost 6 or 7%, paying them off is like earning a guaranteed 6 or 7% return. So you're better off paying off your credit card and student loan debt before investing in the stock market. How do you spend your money before investing? The answer is to work off your debt and have enough money in the bank to last 6 to 12 months, just in case you lose your job tomorrow. These are tough criteria to meet, which makes it difficult to start investing early. But the safest way to be a good investor is to have as little debt as possible. Be comfortable having some money in the bank so you can pay for living expenses until you find a new job. If you've reached those goals, putting away money you don't need, then you have demonstrated good money management and therefore you should be able to invest successfully. The psychology of investing. Let's talk a little bit about the psychology of investing. So we've talked about some of the technical factors and how to think about what a business is worth. You want to buy a business for a reasonable price. You want to buy a business that will last forever, that has barriers to entry and where it will be hard for other people to compete with it. All of these things are important, but even so, a lot of investors don't follow these rules. The problem is that when people put them into practice and there is a panic in the world, the stock market is falling every day. And if their IRA or investment account is falling, they tend to do the opposite of what makes sense. So that's why I talked about how important it is to be financially comfortable before you even start. You want to be financially stable. Managing student loan debt is important. Revolving credit card debt is something you want to avoid. If you're financially comfortable, your stock market risk won't affect your lifestyle. Resist herd mentality. If you don't need the money tomorrow, you can handle stock market volatility, which might affect you emotionally, depending on the type of person you are. As stocks rise, people feel wealthy. Stock prices reflect short-term thinking. It impacts short-term investor stock purchasing and selling. Long-term though, stocks tend to be worth what those businesses are worth. If you purchase businesses at attractive prices, hold them for a long time, and they rise in value. You'll make money as long as you don't have to sell. Investors must be able to resist herd mentality. When the stock market falls daily, you want to sell. In stock market bubbles, you should sell while the stock market is rising daily. In stock market busts, you should purchase and have discipline. Stock market volatility requires a strong stomach. Being secure helps you stomach stock market volatility. You must be confident that you have enough money in the bank to last many years without needing your investments. That's important. How do you get comfortable with volatility? You have to recognize that the stock market in the short term is what we call a voting machine. It reflects short-term whims. Stock prices are impacted by numerous variables, including world events that have little to do with the worth of the company you're investing in. So you have to realize that what you own might go down considerably after you acquire it. It doesn't imply you made a bad investment, just stock market volatility. How do you get comfortable? Well, the way you get comfortable with the volatility is you do a lot of the work yourself. You don't just buy a stock because you like the name of the company, you do your own research. You get a good understanding of the business. You make sure it's a business that you understand. Okay, to recap, if you want to be a successful investor in the stock market, you need to do a few things. Make sure you understand the company you're investing in. Invest money you won't need for years. And don't invest in the stock market if you have any high interest debt. Mutual funds. Okay, let's say this is not for you and you don't want to invest in individual stocks. You may be thinking that it just seems too risky and don't have time to look things up on your own. What are the alternatives? Well, you could hire someone else to do your investing for you. A beginning investor has a few different options for how to handle their money. They can hire a money manager or a group of money managers. Mutual fund companies are the most common example of this. What then is a mutual fund? A mutual fund is technically a corporation, but where you buy stock in this corporation and the manager selects a portfolio of stocks. What they do is they pull together money from a large group of investors and invest that money in a variety of securities. Now, the benefit of this method is that you can buy into a diversified portfolio with as little as $1,000 and have it managed by a professional who gets paid to do a good job for you by investing in the market. So mutual funds could be a good investment. However, the problem is that there are probably up to about 10,000 different mutual funds, and some are great and some are not. To find a good mutual fund manager, you need to do research, just like you would do to find individual stocks. So it's not quite as easy as just picking up any old mutual fund. How to pick mutual funds. Here are a few important things to keep in mind when choosing a mutual fund or any other type of money manager. First, you want someone with integrity. If you're a beginning investor, you should invest in a mutual fund sponsored by one of the major mutual fund companies, rather than a smaller mutual fund sponsored by a company you've never heard of. Larger institutions have a reputation to uphold and can generally be trusted not to take your money. Second, you want someone whose investment strategy makes sense to you. You know what they do and how they do it. Be sure that they are not trying to make you feel insecure by using words and phrases you don't understand. If they cannot tell you what they do, how they do it, and why it makes sense in 2 minutes, you shouldn't invest with them. You want a value-based investment strategy. This may seem obvious, but value investing has a lengthy track record of success with investors. There are other types of investing, such as technical investing, which analyzes charts and stock price history. This method simply bets on stock price swings. Technical investing can be very challenging and is thought by many to be an unreliable investment strategy. We will talk more about this in other videos. You really want someone buying stock in companies based on their judgment that the business prospects are bright and that the amount paid is a good price. You want to invest with someone that has a long-term track record, and 5 years is the absolute minimum. And ideally, you want someone who has 15 to 20 years of experience investing in the markets, because there is a lot that you can learn being a long-term investor in the market. You want someone whose interests are aligned with yours. If it's a mutual fund you want, then to have a lot of money in their own mutual fund. If it's a hedge fund, which is a privately sold fund for investors who have a higher net worth, you want a manager who is investing alongside you as well. If you are building a stock portfolio on your own, without mutual funds, you don't want to put all your eggs in one basket, and you want a reasonable degree of diversification. The more work you do and the higher the quality of the business you invest in, the higher quality your portfolio can be. Remember to only invest in low-leverage businesses. For an investor in individual stocks, you want to own 15 to 20 securities. If you invest with mutual funds, you still do not want to put all your eggs in one basket either. So you'll want 2 or 3, maybe even 4 mutual funds or money managers to diversify your assets. Alright, that's the end. So now you know the psychology of investing in mutual funds. This ends our 4-part series. We're going to wrap things up here. We hope you liked this video. If you want more information on this, check out our other videos on the screen. Thank you for watching.